Welcome to today's Explainer. We are unpacking something that is completely shifting how we look at tech infrastructure. We're going to take a highly structured journey right through the very foundation of the accelerating AI ecosystem. Specifically, we'll be breaking down the 8 key stocks that are driving both the physical and the digital layers of this massive technological shift. So, if you're focused on understanding how this infrastructure is actually being built from the ground up, you are in the perfect place. We're going to use a stack-building approach to figure out exactly who is supplying the picks, the shovels, and the raw power for the AI gold rush.
Back in June, everybody panicked, right? We saw this massive market sell-off where the chip index dropped 10%, nuclear stocks gave back 30%, and some quantum names were cut in half. It really created the illusion that the AI bubble was popping and the trade was breaking. But then, you look at the hard data coming from Micron. They reported a staggering 346% revenue increase and an 85% gross margin. Even crazier, their most advanced AI memory is already completely sold out through 2026. That tells us a totally different story. The AI build-out isn't cooling down, it is actually accelerating. So that recent market dip, it's really a rare window of opportunity.
Here is our game plan for today. We're covering 1. The AI boom is accelerating. 2. Powering the AI revolution. 3. Mega-cap chip monopolies. 4. Software and networking giants. 5. High-risk small-cap suppliers. And finally, 6. Sizing your AI portfolio. Let's get right into it.
Part 1. The AI boom is accelerating.
Moving right into Part 2. Powering the AI revolution.
The massive physical infrastructure required to actually run artificial intelligence is being aggressively built out as we speak, and demand is absolutely crushing supply. I mean, think about it. Before you can even run a single AI model, you need massive, uninterrupted amounts of electricity to keep those data centers alive. Which brings us to the number $46 billion. That staggering figure represents the market for our first stock, Eaton. They build almost everything an electron passes through from the grid to the server. Their electrical content runs about $3.4 million for every single megawatt of AI compute built. With the industry on track to build 13.6 gigawatts of new data centers this year alone, it opens up a $46 billion electrical equipment market. To put that into perspective, Eaton's revenue for the entire company last year was $27 billion. One single year of AI construction opens a market bigger than their entire previous year's business. So it's really no surprise their data center orders just grew by 240%.
And if you peek under the hood at Eaton's profitability, wow, the transformation is hiding right in plain sight. 6 years ago, this was a traditional industrial company running a 13% margin. Today, their core electrical business is running at 22.7%, pushing the whole company near a 20% margin on over $27 billion in revenue. Basically, even as their top line grew, these wider margins meant they nearly doubled their overall profits.
Sticking with power, our second stock is BWX Technologies. Now, this isn't some speculative pure-play startup. It is a multi-engine monopoly. They're the sole manufacturer of reactors for the U.S. Navy. But beyond defense, they're building North America's first reactor pressure vessel for small modular reactors, they're supplying nuclear fuel to help power Google's AI, and they're even producing critical cancer isotopes in their medical arm. While all the hyped-up pure-play nuclear stocks dropped 30% recently, BWXT only gave back 17%. Why? Because they are actually building reactors and getting paid for it today. They're sitting on a record $8.6 billion backlog, and their free cash flow is leaping from $46 million up to nearly $300 million by 2025. Yeah, they've got a high 43 price-to-earnings ratio, but the quality of this business is just undeniable.
All right, Part 3. Mega-cap chip monopolies.
We've covered the foundation, so let's move up the stack to the heavyweights. And naturally, we have to start with NVIDIA. But the crucial point you have to understand is that it isn't just about silicon. NVIDIA's true moat is its CUDA software platform. It's basically the operating system of the AI boom, locking in around 6 million developers. That is an advantage competitors just can't easily break. Plus, NVIDIA doesn't just sell a chip, they sell entire server racks. They build the platforms that humanoid robots run on, and the software for quantum computing. Whoever eventually wins the AI race, the robotics race, or the quantum race, they all still have to pay the piper, and the piper is NVIDIA. Over the last 3 years, their revenue skyrocketed 8-fold, from $27 billion to over $215 billion, with their networking arm alone tripling.
But here's a number that's going to stop you right in your tracks: 0.5. Just think about this for a second. As NVIDIA's stock price went to the moon, the company actually got cheaper.
How is that possible? Well, its price-to-earnings ratio fell from over 100 down to about 30. Its earnings grew even faster than its skyrocketing stock price. That gives NVIDIA an incredibly cheap PEG ratio, which measures price against earnings growth, of near 0.5. Anything around 1 or lower means a stock is extremely cheap for the growth you're getting.
Which brings us to the other side of the mega-cap trade. There's a famous joke in the industry that goes, Broadcom is the one that they call when they want to stop paying NVIDIA. When tech giants like Google, Meta, OpenAI, or Anthropic want to build their own custom AI chips to escape the NVIDIA tax, they team up and co-design those chips with Broadcom. And it gets better for them, because Broadcom also sells the networking gear that wires those chips together. They literally get paid twice on the exact same cluster. That beautiful dynamic drove Broadcom's AI revenue up 140% last quarter, backed by a massive $73 billion order book.
A lot of people thought Broadcom's recent VMware acquisition would weigh them down. Actually, the exact opposite happened. VMware software runs at a really rich 77% margin, which lifted Broadcom's baseline 58% chip margin. Now, some accounting quirks make their current PE look artificially expensive at 60, but if you look at next year's real earnings, it trades closer to 24 times. With the PEG ratio also sitting right around 0.5, Broadcom is just as cheap for its growth as NVIDIA. They really are the ultimate arms dealer in the AI chip war.
Next up, Part 4, Software and Networking Giants.
Let's shift our focus over to the companies building their own custom silicon and the networking backbone wiring everything together. Let's talk Alphabet, which is arguably the cheapest megacap in the entire group. Alphabet actually designs its own TPU chips, so it mostly avoids paying that NVIDIA tax we just talked about. But their business is really 4 separate engines firing at once. Search growth nearly doubled from 10% to 19% thanks to AI monetization. Google Cloud revenue is up 63%, their margins doubled to 33%, and they're sitting on a $460 billion backlog. Meanwhile, YouTube just quietly surpassed Netflix as the most watched TV service in America. And Waymo? They are doing over 400,000 paid robo-taxi rides every single week. Even when you strip out a one-time paper gain, Alphabet is a deeply undervalued powerhouse, trading at a 24 PE with a 1.3 PEG ratio. It's basically the ultimate diversified safety play in AI.
Next in our networking anchors is Arista Networks. For years, the gold standard for connecting GPUs inside an AI data center was NVIDIA's proprietary tech called InfiniBand. But today, the whole industry is pivoting to Open Ethernet, which is exactly Arista's home turf. Meta famously proved this shift works by running a massive cluster of over 24,000 GPUs entirely on Arista Ethernet, and it matched InfiniBand's performance perfectly. That massive industry pivot is what helped double Arista's AI networking revenue last year.
$6 billion. That's how much deferred prepay revenue is just sitting on Arista's books right now. Customers are literally prepaying for equipment well ahead of delivery. Underneath it all, Arista is an absolute financial fortress. Zero debt, $12 billion in net cash, and operating margins widening from 30% to 43%. But we do have to mention the valuation. At near 44 times forward earnings, its PEG sits close to 2. That makes it the richest valuation in the group we're looking at today. For Arista, price really matters, which means pullbacks are absolutely your friend.
Let's drop down a level to Part 5, High-Risk Small-Cap Suppliers.
Okay, we've covered the giants. Let's drop down the stack to the picks and shovels component makers acting as essential traffic controllers. The risk is way higher down here, but for sure, so is the potential reward. First up is Rambus, a totally vital player in the highly exclusive traffic control club for AI memory. A decade ago, this company was a money-losing shell with a negative 38% operating margin. Today, it's a debt-free, highly profitable chip company rocking a positive 37% margin. But here's the ironic twist. When memory prices spike and fewer physical modules ship, Rambus actually feels it as a headwind. You add in a high 60 PE, a PEG well above 2, and a current DOJ inquiry overhang, and you can clearly see where that high-risk label comes from.
Our other small cap is Fabrinet, which is the purest optical manufacturing play in this basket. They physically build the transceivers connecting these GPUs, and man, it is an incredibly sticky business model. Think about it. Aligning lasers to a fraction of a human hair inside a clean room takes years to qualify. Once a customer like Cisco or NVIDIA locks in, the switching costs are astronomical. That exact stickiness helped drive a 90% growth in their data center business last year. They earn a 20% return on capital with zero debt, even with structurally thin 12% gross margins. The big catch here? They're heavily concentrated. Just NVIDIA and Cisco alone account for about half of all their sales.
Finally, Part 6. Sizing your AI portfolio.
We have officially analyzed all 8 stocks across the AI stack. So how do we connect these data points into an actionable strategy for you? The most crucial thing right now is how you actually construct a basket. The smart move is to build an asymmetrical stack. That means a large chunk of your allocation goes heavy on the megacaps, the Alphabets, the Nvidias, the Broadcoms. They provide core stability and they are raking in massive cash right now. Then you scale down to a much smaller slice for those high-risk, high-reward small caps, like Rambus and Fabrinet. By sizing it asymmetrically, if the small bets pay off, fantastic, you get the upside. But if they run into headwinds, their smaller allocation ensures they don't drag your entire portfolio down with them.
Which brings us to the ultimate question for today. How are you positioning your own portfolio to capitalize on this massive build-out? Everything we've looked at, from raw energy usage to optical factory constraints, shows us that the physical infrastructure of AI is speeding up. It's not slowing down. That makes market dips like we saw in June rare, foundational building opportunities. So, are you going to be the one buying the gold, or are you going to be the one selling the shovels? Thanks so much for hanging out with me for today's Explainer. Keep learning, and I will catch you next time.